In the last video, we looked at the basics of the Spanish compliant investment bond. This time around, we're going to take a look at 5 more reasons this type of tax-efficient investing is a great solution for residents of Spain. So previously, we looked at the more obvious benefits of investing your money into a Spanish compliant bond, such as deferring tax, proportional tax relief on withdrawals, and estate planning. I also explained that these vehicles attract such benefits because they are written as unit-linked life assurance policies. But if we take a closer look, there are even more advantages over standard investment platforms. Firstly, let's talk about Spain's much-loved Modelo 720, otherwise known as the Declaration of Overseas Assets. Now, if you have non-compliant investments such as UK ISAs or offshore portfolios, for example, with a value over €50,000, you or your accountant must report them on the Form 720. This can be complicated and onerous for even the best Spanish accountants, as they have to list each of the underlying investments, not just the structure they're held in. And if mistakes are made, which they are, a fine for each error could be payable. The more complicated your overseas investments are, the more stressful this can be. So what difference would holding all your investments in a Spanish compliant bond make? Well, the companies producing these structures are located outside Spain, usually in Ireland or Luxembourg, for example. And according to the tax authority's own website, life assurance investment products offered by EU-based firms under Freedom of Services rules do not need reporting on the Modelo 720. Why? Because a Spanish compliant bond provider must have something called fiscal representation in Spain, such as an accountancy firm, who they employ to do all the reporting to the Spanish tax authority on your behalf. So no Modelo 720 and crucially no mistakes. Now this type of reporting brings me on to the second point out of our 5. We know already that when you take a withdrawal from your bond, only the growth element is taxed. That's your proportional relief. But who calculates this? You? Your accountant? Well, in fact, this is all done for you by the life company. If there is any tax to pay, they calculate the relief and pay the tax on your behalf, giving you a document to show what they've done. Now my third point, and one which is sometimes overlooked, is investor protection. In other words, what happens to your investments if the bond provider gets into financial trouble and in the worst case scenario goes into administration? Very unusual, but in theory it can happen. Well, in both Ireland and Luxembourg, the law dictates that life assurance companies cannot hold their clients' assets on their balance sheet. Therefore, if the company were to fail, your money is ring-fenced and cannot be used to pay creditors. Furthermore, each life company must adhere to something called solvency capital requirement rules. It sounds boring, but it's important, as it means each firm must hold assets of their own in excess of 100% of all their customers' assets to protect themselves against insolvency in extreme conditions. Now, of course, if you're invested in poorly performing assets, this is not going to prevent the value of your portfolio decreasing. But that's where we come in, as it's our job to make sure you're invested in a wide range of diversified, well-performing investments within your bond. So on to the 4th additional benefit of this type of investing, succession planning. As the bond is a life assurance policy, it can be written on a joint life second death basis. What impact does this have? Well, in Spain, inheritance tax can exist between spouses, and we've seen this catch some people out in the past, where a spouse or legal partner dies and leaves unprotected assets or cash balances to their wife or husband. This is completely avoided when your assets are held in the Spanish compliant bond, as upon the death of the first policyholder, 100% of the rights to the policy pass to the surviving policyholder without exposure to any tax. Furthermore, on the death of the second policyholder, the bond is encashed and the money paid out to your named beneficiaries. Now, the burden of inheritance tax in Spain falls upon the beneficiaries rather than the estate of the deceased. But if the beneficiaries themselves don't live in Spain, let's say grown children living in the UK, for example, and the asset being passed on to them is not in Spain, such as a Spanish compliant bond provided by a life assurance company in Ireland, then there is no Spanish inheritance tax to pay. Now, for the fifth and final advantage, the buying and selling of assets. If you hold a non-compliant investment portfolio outside of Spain, each time you or your appointed investment manager buys or sells assets, then there is a potential capital gains tax liability for every transaction. Over time, this could have a negative effect on the portfolio value, as well as a heavy administrative burden for you and your accountant. In a Spanish compliant investment bond, the assets held within the wrapper can be bought and sold at will, without triggering an exposure to tax and thus allowing your portfolio potentially stronger growth due to the compounding effect when 100% of the gains are reinvested. So I hope I've shown you how this is a great way of investing your money if you're a tax resident of Spain. And if you'd like more information, please do get in touch. You can also see the link here to my first video on Spanish compliant bonds. That's it for now. Thanks for watching, and until the next time, it's bye from me.